Sure, you've probably heard people throw out terms like mutual funds and index funds, but what are the differences and which one would be better for your portfolio? You might be tempted to think that the difference between the two investments is small, but that's not necessarily true. The difference may actually end up costing you hundreds of thousands of dollars over the course of your investing lifetime. Learn the differences between these two common investment vehicles to ensure your hard-earned money is providing you with the largest return for your retirement years. Mutual funds. Mutual funds are managed portfolios of stocks and bonds. You can think of a mutual fund as a company like Fidelity or Morgan Stanley that brings together a large group of people and invest their money on their behalf in this portfolio. Each investor holds shares in a mutual fund, which represents a proportion of the holdings managed by the fund. Mutual funds are operated by money managers who creates portfolios for investment with the pool of invested cash. Long-term growth managers try to beat the NASDAQ or S&P 500 index during a fiscal year. The objective of a mutual fund is to beat the investment returns of related benchmark index. The benchmark index or market is simply a measurement of a relevant section of the stock market. These funds are actively managed by mutual fund managers, stock pickers, and analysts that are constantly working to ensure the holdings of the fund will be the most beneficial for the investors. The funds are usually invested in a mixture of stocks, bonds, and similar securities. There is one major difference between mutual funds and index funds. Managing a mutual fund with daily or hourly decisions is very expensive, resulting in extremely high fees. Actively managed mutual funds are more costly, and annual fees of 3% or more are not unusual. This means, for example, with a nest egg $1 million, you could be paying $30,000 in fees yearly. Index funds. An index fund is a type of fund built to match or track the components of major market index, such as the S&P 500. As with mutual funds, there are many index funds available. For example, you can buy a fund that is solely invested in growth stocks, a fund that invests in dividend-paying stocks, or a fund that owns only international stocks. Some of the most popular index funds are those that track the S&P 500 or the Dow Jones Industrial Average. An index fund is said to offer broad market exposure and low operating costs. Index funds are often made up of stocks, bonds, or similar securities that are meant to closely resemble an index. Index funds tend to be cheaper, with the cheapest options charging less than 0.2% per year in expenses. The index funds aren't actively managed, but instead automatically match the market trends. Performances solely result of market changes within a certain selection of stocks, not someone trading in and out the markets. This is why there is a dramatic difference in management costs, or so-called expense ratio. So if you have $1 million, the annual fees or expense ratio of an index fund will be close to $2,000. Tony Robbins says that if you have two people each with $100,000 and one person pays 1% fee on their investment fund and the second person pays 3%, the person paying 1% will have about double the money in their account over time. The average mutual fund charges an annual fee of 3.1%, which is much higher than the 0.2% annual fee for the average index fund. Consider purchasing index funds from tax-advantaged accounts or free brokerages like Robinhood to save on your expenses. It's worth paying attention to the fees you're paying, as it could cost you a lot of money over the long term. In history, it's been shown that it's extremely difficult to beat the market over time. Index funds allow you to invest in the market at very low cost instead of paying a higher fee, so experts can attempt to outperform typical investment returns. Time after time, we've seen that the low cost of an automatically managed fund far outweighs the benefits of an expensive actively managed fund, which encourage of your portfolio year after year, whether or not the investments lose or gain value. Overall, index funds can be a very efficient way to invest with little thought, simply buying into a fund that offers an accurate representation of the market in general. However, if you can stomach expense and feel confident that you can find the rare actively managed fund that will outperform the benchmarks, then you're free to try to beat the odds and go the active route. If this video was helpful, don't forget to like and subscribe. Hit that bell to never miss out when I upload a new video. See you next time.